There are times when, if you tune into the show, it's all about the Federal Reserve and trade policy all the time. I prefer to focus on the fundamentals of individual companies. You know that, trying to help you identify winning stocks. But there are moments when these big picture macro forces trump what's going on at the companies themselves. No pun intended. We just went over the Federal Reserve, what they really do, why they feel compelled to raise interest rates in a strong economy, why those higher rates are bad for business for the vast majority of the companies we follow, and why the Fed eases up when the economy gets too weak to try to get it back going again. But there's another mechanism that makes rate hikes devastating to Wall Street, long before the damage spreads to Main Street. It's the same reason that stocks soar when we get a signal that the rate hikes will stop. I'm talking about the very nature of the stock market itself. I like to say that the market's a forecasting machine. The business is all about anticipation. Millions of traders and investors make bets on stocks. Each one of them is trying to predict the future, not looking at their screen and saying, oh, that's the price. Taken individually, tons of these wagers will turn out to be wrong. Taken together, the market is surprisingly good at making predictions. The end result is that the stock market tends to reflect not the present, but Wall Street's collective views about the future. Say 6 to 9 months out, that's the worldview. So when we get a new piece of data that changes our impression of the future, it could have a dramatic impact on stock prices immediately. If money managers suddenly get the sense that the economy is going to gradually slow down over the next 6 months, what happens? Stocks don't go down gradually along with the economy over the next half year. No, stocks go down immediately, violently, because so many investors are suddenly anticipating a slowdown, and they take action. That's how you end up with a horrific decline like we had in 2022. I say decline, but really, you know what? It was a sudden onset of a bear market. Coming into the end of 2021, if you didn't look too closely, the economy seemed to be on fire. Employment was incredible. Aside from some signs of fraud, business was booming. During the pandemic, the Fed had cut interest rates to nothing. They were practically printing money. So we got all sorts of business formation, tons of low-quality IPOs, I should add, not to mention those garbage SPACs that, I hated so much. But come November 2021, the Fed warned that inflation was getting out of hand, and rate hikes were on their way. Immediately, all of the highest-flying growth stocks got obliterated, and they spent the better part of the next year plummeting. These things instantly became untouchable. The rest of the market hung in there before finally peaking in the first few days of January 2022. While the Fed didn't actually start raising rates until that March, we all knew the hikes were on the way. And given the ramp up in inflation, it looked like they could be brutal. Wall Street anticipated pain, which is why the S&P 500 lost more than 25% of its value from the peak in January of 2022 to the lows that October. At that point, inflation was totally out of control to the point where investors panicked. And they created a hideous decline. But then long-term interest rates, the kind that are set by the actual market, not by the Fed, started coming down. And everyone took that as a signal that the Fed might be less aggressive with the rate hikes. Something similar happened in a year later. In 2023, there was constant speculation about when the Fed might be willing to stop hiking rates. And by the time we processed that the hikes were truly over and done with by that October, the stock market had taken off. You got to anticipate. While we spent much of 2024 wondering when the Fed would start cutting rates and how many cuts we eventually get, none of that really mattered. While lots of journalists and money managers like to harp on the details, the most important factor here is simply knowing whether the Fed is your friend or your enemy. When the Fed is your friend, meaning when rate hikes are off the table and rate cuts are on the table, the stock market can just roar. As Wall Street can see the potential for cuts coming, we'll get a fabulous bull market. And that's one reason why 2024 was so great for stocks, even though the rate cuts didn't start until September. And even when the Fed came through, the bond market refused to play ball. In the end, though, that couldn't derail us. As long as the Fed is your friend, it's simply much easier to own stocks. Always remember that. This is why we pay so much attention to the Federal Reserve. Its pronouncements affect the trajectory of the economy. The market reacts rapidly to any of these changes, and anything perceived as a big change has the potential to either crush the averages or catapult them into the stratosphere. The key here is that nobody's waiting around patiently to see how everything pans out. If the Fed chief says we're raising rates 3 times next year, traders don't sell next year. They sell right now. If the Fed chief walks back that decision, well, the traders will turn around and buy those same stocks hand over fist. The bottom line here, everyone in this business is constantly looking at the data to piece together their own worldview, a view of how things will look in the near to medium term future. When the Fed or the president or some foreign actor does something that dramatically alters Wall Street's worldview for the worse, it can slay a bull market in the blink of an eye, leading to some frightening declines, which is why I'm trying to prepare you for them, either in any business cycle. If money's back, after the break.
Coming up, you may not always have to care about the Fed, but when they make their presence known, do you know how to react? Cramer's breaking it down for you. Next.
Let me nail this one. All right.
He's enjoying this.
Well, let's just put it away. That's
Jim,
what I
Jim,
want.
it's all over the cafe.
My executive producer's a vegetarian. I thought I'd go some other place.
Let's get him.
So we'll go over the skid pad. I'll do some drifting.
Okay.
And then we'll do a burnout. You sure you don't want to drive?
No. You're in control, and I really appreciate that. Say it while I'm going up.
Yeah, exactly.
It's one shot. Okay, ready? Cramer. Hey, I'm Cramer. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Mad Money. Welcome to Mad Money. Welcome to Cramerica. Welcome to Cramerica. Hello from the city of brotherly love, 140 miles off the coast of Louisiana. Welcome to Dreamforce Conference in San Francisco. I'm on a boat. We're on the Mississippi River in front of Nucor Steel, Louisiana. Mad Money is in the heart of steel country. Mad Money is boots on the ground, in the Badlands. This is what we'll do, find good ideas to invest in America. Who says we don't make anything anymore?
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.